Good morning. I'm Tim Nyland, and over the past several weeks, we've discussed how shipping and freight costs are impacting margins at all levels. Last week, we did a deep dive into the margin analysis of Dollar Tree, Mondelez, and Procter & Gamble. And speaking of shipping and shipping costs, last week, FedEx reported its first EPS miss in almost 2 years. This was the largest miss in 4 years, and they actually cut their full-year guidance, citing higher labor costs and labor shortages as well. FedEx is also going to be raising shipping rates 5.9% next year. So today we're going to look at the growth, valuation, and profitability of both FedEx versus UPS. And we're going to answer the question, why does UPS tend to trade at a valuation premium relative to FedEx? This is not as obvious as you think, and you'll see why in just a moment. Before we get started, please like, comment, and subscribe, and come back every week for more videos on investing strategy and making the most of Zacks Pro platforms. If you would like to do the kind of analysis you're going to see in this video, then you'll need to have a ZAT Portfolio Manager subscription, which includes both Zacks Advisor Tools and the Zacks Research System. Let's go ahead and get started. On the screen, you'll see that I have a 20-year price and earnings chart out of the Zacks Research System. And for today's webinar, we're actually not going to have a slide deck. We're actually going to do all of this modeling live. And I've actually set up a pitch book specific to this particular webinar called FedEx versus UPS. So if you happen to be a Zacks Research System subscriber, please be sure to reach out to our customer support if you'd like a copy of this pitch book to go ahead and load into your system. So what we're going to do obviously today is we're going to look at FedEx versus UPS. I've already got the symbols loaded into my symbol monitor. And we'll go ahead and start out with the price and earnings chart, again, at a 20-year chart. And the first thing I want you to think of when you think of FedEx versus UPS, I want you to think of air versus ground, right? So FedEx obviously much more centric to air shipping in logistics, and UPS obviously much more centric to ground shipping, okay? So that's going to have a lot to do with the valuation differences we're going to uncover here in just a minute. So just to orientate you both, or orientate you all with the price and earnings trends, it's very important to notice how there is a lot of cyclicality in this business, okay? And you can see here the difference between UPS and FedEx. FedEx experienced quite a trough in that air shipping versus the ramp up in UPS that it had during COVID, obviously delivering a lot of those Amazon packages and other ground transportation requirements that were so key to getting through COVID. So you can see a little bit of a difference here in the business model and how this is actually playing out in terms of price and earnings. You can see UPS PE multiple very much so elevated, whereas if you look at Federal Express, you'll see that FedEx is looking more like a broken growth stock. It almost appears as though the buy side is bidding this to where earnings are actually going to continue to head south. You can see that this happens on a fairly regular basis with FedEx. You can see all of these earnings scares in the form of these price troughs that we have from time to time. And right now, obviously, we're in the midst of one of those. So this is the perfect time to do this type of analysis and understand the difference between these two companies that many get so confused. So we're going to clear that up right now. So the first thing that we're going to do is we're going to take a look at our next view in this particular pitch book, which is going to be our PEF12M. And what I want everyone to notice, again, with a 20-year history, is that UPS in red tends to trade at a premium on that forward 12 multiple almost throughout its entire 20-year span. And you can see that there's actually a sizable difference, right? 10.88 on FedEx versus 16.42 on forward earnings for UPS. And if we make that a relative, the importance here is that you'll see that we're actually almost trading at a 20-year low relative forward PE multiple. So we're currently trading at 0.66, which is basically a 34% discount to UPS, and its low is 0.64. Its median is 0.84, and that basically tells you, if you basically just subtract one from that, it's basically telling you that FedEx normally trades at about a 16% discount to United Parcel Services. So I want you to keep this in mind. It's very important, right? Because the interesting thing is that we oftentimes associate growth with forward multiples. In other words, if we see that one particular company is growing faster than another company, we would assume it to have a higher PE multiple or a larger PE multiple. So just pay attention to the fact that UPS is trading at a significant premium to FedEx when we look at some of these growth rates that we're going to do here in just a minute. So quickly, I'm going to turn on the valuation model. And many of you have seen this. This is obviously our proprietary equity valuation model in the research system. And I always remind everybody to go ahead and set it back to default, because you just never know when you've been in here modeling. And the very first thing I want to do with FedEx and UPS, I want to look at their long-term least squares growth rates. And so again, doing a right mouse click, I'm just going to set this to 20 years, do a least squares trend rate. And I'm going to see that FedEx is actually growing at 9.33%, right, over the long term. That's a 20-year trend. I'm going to do the same thing for UPS. I'm just going to compare these growth rates very quickly. I can go ahead and save that model definition. It doesn't really matter. We're going to come over here in just a minute and change it again. So I'm going to click on user model here for UPS, and then click on default, and then click on the least squares trend rate. And you'll see that it's only 6.74%. So now we've got our first valuation anomaly that I warned you about, right? The differences between FedEx and UPS aren't as obvious as you think, right? So long-term, FedEx has actually grown over 9%. UPS has actually grown only at 6.75%. And obviously this is earnings. Yet UPS is actually trading at a valuation premium to FedEx, okay? So we need to understand this a little bit more. So what's going on? Well, we need to then take a look at the market implied growth rates for the United Parcel Service, UPS. And you can see that the current bid to valuation, and we would expect this, right, to be much larger than FedEx because we're trading at a much larger PE ratio. Market implied long-term growth rate, and again, this is about a 3 to 5 year growth rate that we're calculating here. The buy side is betting on average about 4.34% earnings growth. And if we look at FedEx, we expect that number to be very different, right? Because it's been bid down to a PE multiple of 10. So if I click on user model, click on default, click on the market implied growth rate, you can see here that I'm sitting at basically, let's just call it 0% growth, right? So FedEx basically currently being priced for Armageddon. Perhaps it's justified, right? We've got a Zacks rank of sell. And as a matter of fact, if we look at the EPS estimate revisions here very quickly, I'll go ahead and save those settings as well. You can see that FedEx, right, commensurate with their warnings last week, their estimates are in fact down. You can see that we just got these EPS revisions in here about September 24th. And you can see for FY2 the same exact trend, right? We look at UPS, a little bit more stable, right? So the other thing that you want to note here as well is that FedEx's employees aren't unionized to the extent that UPS is, right? So UPS has unionized employees, and they too are heading into union meetings where I'm sure the labor costs are going to, that issue is going to come up. So I'm not sure that UPS is going to be 100% insulated from this EPS revision that FedEx took a haircut on. Labor shortages, labor costs, I would expect that to hit UPS as well at some point. But for now, we can see that in the estimates that's non-existent, or perhaps not, right? So we're going to take a look at that a little bit more in just a moment. So the interesting thing here is that I've created this pitch book for us to basically go through and do this analysis. And I left one of the views out on purpose. And I wanted to show everyone how to do a pitch book on the fly. So we'll go ahead and grab that view here in just a minute. There's actually, just one view that I left out. And we'll go ahead and add that to our pitch book. So before we get going on that, let's just take a look at the cash flow analysis differences here between UPS and FedEx. The one thing that I want to bring everyone's attention to is that UPS tends to be a little bit less capital expenditure driven business than FedEx, right? Just given the fact that we're dealing with airplanes versus trucks, more trucks on UPS than FedEx, really focusing on that air transportation. So you can see that in terms of CapEx, UPS versus FedEx actually going to come in with a lot larger CapEx. These items are obviously going to play out when we take a look at, in terms of valuation and profitability, the differences. Remember, we're trying to answer that question. Why is it that UPS carries such a valuation premium in terms of a PE ratio? And right now, we haven't really seen it, right? Because the growth rates for FedEx appear to be much larger outside of this most recent downturn in EPS forecast. FedEx has been able to grow EPS at over 9% when UPS is just over 6%. So it's not making a whole lot of sense now, but we're getting there. Okay, so the first thing we want to do is we want to take a look at margins, and we're going to take a look at relative margin analysis as well. So to do that, I'm going to go into the custom charts, and we're going to go into the default Zacks templates, which is where I have my margin analysis, absolute and relative charts. So I'm going to pull these up, and as I pull them up, I'm going to click the plus button and go ahead and add those to my pitch book. So this is what I've referred to as pitch book on the fly. I've got a Zacks margin analysis absolute, and we'll go ahead and bring in the Zacks margin analysis relative as well. Click the plus button. Now they're both in my pitch book. And we'll go ahead and start with the margin analysis on an absolute basis, right? So when we look at FedEx, and again, I like to get in here for scaling, look at like a 5-year chart just so that we can kind of focus in on those trends. This is stuff that we've talked about the last couple of weeks. So I can see revenue growth here nice and stable, sitting at like 21% or so. But I can see the costs obviously trickling in, right? So cost to transport the packages obviously eroding my gross margins. I can obviously see my operating margins also taking a hit, and that is obviously compounding to erode my net margins, right? And that's what we're seeing in those EPS estimate revisions. And so if I look at this relative to UPS, I'm just going to go ahead and stay on the absolute chart here for just a minute. And I'll go ahead, and it's actually not going to save it because it's a Zacks default template. But at any rate, you can see that we've also had stabilization in revenue growth. And here again, United Parcel Services revenue growth actually a little bit lower than FedEx, which is interesting, right? Even though UPS is carrying a higher valuation premium. So there's another anomaly. But you can also see here gross margins, right, eroding as well. So cost pressures. But you can see operating margins, right? Take a look at these operating margins. These are substantially higher and growing. And you can see that this combination of declining gross margins and this tremendous ability to cut their operating expenses, right? That's primarily going to be your SG&A and R&D, has resulted in this tremendous prop up in net margin. And so that's super, super important to note. And the other thing I want you to note here is the margin differences, right? 75, 15, 10.2 for United Parcel Services. And when you switch over to FedEx, you'll see that they're much lower, right? 7.36, 6.18, 5.53, okay? So that would more or less bode well as to perhaps why United Parcel Services, maybe one reason why United Parcel Services might trade at a valuation premium. It's a little bit higher margin business. So we can take a look at this on a relative basis, and at that point, it'll just be subtracting these two series, and I'll go ahead and switch this down to a 5-year history. So you can see FedEx margins relative to UPS. I apologize. I believe it's actually dividing the two series. So you can see that margins are literally 41% and 54% of UPS. So UPS, obviously a much higher margin business. So for every dollar of revenue that's coming in, there's a lot more of that money getting to the bottom line for UPS, okay? So that's definitely an analytical issue of relevance. So keep in mind, here's what we're trying to solve. Right, I'm not going to save this time. We're trying to solve for the reason why this is carrying such a higher valuation premium in terms of UPS than in FedEx. So UPS trading at that PEF12M of 16.42, FedEx trading at 10.88. Recall that when we looked at least squares trend rates for growth, right, FedEx has grown over the last 20 years, much higher clip than UPS. About the only thing that we can see is that FedEx is a much higher capital intensive type business. And we also see that that's translating into United Parcel Services having substantially higher margins. So if we combine the effects of the capital intensive business together with the margins, then perhaps we could focus on some of these profitability metrics to maybe explain why Federal Express trades at a discount to UPS. And so the very first one that we're going to look at is the return on assets, right? And here's where we can start getting some answers, okay? There's a clear difference between the business models of UPS and FedEx. The ability for United Parcel Service to basically compound returns against its asset base is basically almost 3 times that of Federal Express, okay? So when you're solving for valuation and trying to justify or otherwise challenge valuation measures, you've really got to lift that hood and kind of and dig into the capital intensiveness of the businesses, because where you think that FedEx and UPS would be so similar, they're very different in terms of their capital structure. Okay, and you're going to see this play out in terms of these profitability ratios. And remember that profitability ratios tend to combine the effects of both what's coming down the income statement in terms of your net income, right? So it combines all that margin analysis that we spoke about last week. And now this week, we're going to put it together with what's going on the balance sheet, right? Which is your capital structure. So here we're putting it all together. Return on assets for UPS, 3 times that. That would certainly warrant a higher PE ratio for United Parcel Services, which is what we're seeing. Same thing with ROE, right? United Parcel Services literally just knocks it out of the park relative to Federal Express, okay? Same thing with return on capital, right? So overall ability to compound basically net income, compound returns on its capital structure is 3 times that of Federal Express. So this is by far one of my favorite capital efficiency ratios, and you can see that there's just a huge difference between UPS and FedEx here. It would definitely justify that difference in PE ratio that we're seeing. But what's even more important probably in this case, because we're talking about such capital intensive businesses, don't get me wrong, UPS is very capital intensive, but FedEx even more so. When we start talking about these free cash flows and the fact that UPS is almost 4 times more efficient at generating free cash flow on invested capital than Federal Express, right? So there's just a lot of weight, a lot of difference between these two companies in terms of their balance sheets. And you can see all of this play out if you focus on these profitability metrics. So in terms of trying to create a valuation framework to analyze or otherwise justify the valuations of 2 companies that appear to be very similar when in fact their capital structures are totally different, you would use this same framework, right? And we'll make this framework available to you if you go ahead and reach out to either me directly or our support staff. We'll go ahead and make this pitch book available for you. I've called it the FedEx versus UPS pitch book for purposes of this webinar, but it's really just a very well-rounded valuation framework where we look at valuations, right? We look at PE ratios, we look at market implied growth rates, we compare that to long-term trends in lease squares growth over the past 20 years. We took a little bit of a look at the cash flow analysis. We took a little bit of a look at the capital structure, and realizing that that Federal Express was much more capital intensive than UPS, then we focused on those profitability metrics as well as the margins themselves. So a little bit more of a complete analysis here for you this week, and I hope you found this valuable. In most of my weekly strategy calls, I analyze not only the market, but stocks in search of analytical issues of relevance to share with you and my team. So if you find that this analysis is valuable, mark your calendar for our next Lunch and Learn webinar this Friday, October 1st at noon Central. My colleague, Meyer Thacker, will be hosting a webinar with an intriguing title called The Anatomy of Multi-Bagger Stocks That Will Multiply 10 Times and How to Find Them. Meyer's going to explore the timeless principles of compound interest, retained earnings, and capital deployed to basically study the anatomy of multi-baggers of the past. This will be a really interesting webinar. So using this framework, he'll lead the search for stocks that could deliver returns equal to multiple times the investment over the next decade. So you'll definitely want to watch this one. Remember, it's this Friday at noon Central, and you can register for free at the link in the description below. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or ideas for future videos, please leave a comment below or email me at tnyland@zacks.com. You can also follow me on social media. I'm on LinkedIn and I'm on Twitter at Tim Nyland. If you're interested in getting started with Advisor Tools or ZRS, or you're looking to upgrade your current subscription, please contact our world-class support at advisortools@zacks.com and zrs@zacks.com. Thank you for watching, and I'll talk to you all next week.